Just start off with you in the global wrap today. What caught your eye, Nadir?
Yeah, look, I mean, obviously big news story coming out of Saudi Aramco. We got a first glimpse into how big that company is, and twice the size, twice the profitability of Apple. So that's definitely no number to be scoffed at. The IPO been put on the back seat, but obviously they need to do the bond raising for the purchase of an oil company in Saudi Arabia. That's going to cost them $69 billion. And it's going to be interesting to see what kind of valuations put on that company. If Apple's over $1 trillion, well, you know, if common sense tells you double the profitability, double the market capitalization. Unfortunately, it doesn't work like that. So, you know, are we going to look at a market capitalization somewhere in the region of $2 trillion? I suppose we'll have to wait and see. Interestingly to see, the markets are very sanguine about the inverted yield curve. You know, we kind of panicked about that very briefly, and we seem to be very much over the fact that the yield curve inverted in the US, and I think correctly so. You know, inverted for a very brief period of time, which is unlike what has happened historically. And the second point is that long-end yields are obviously being artificially depressed by the amount of quantitative easing that's in the system, and the fact that the Federal Reserve is battling to back out of this quantitative easing program. So there's an artificial anchor on the long end of the curve rather than regular supply-demand factors which are driving the inverted yield curve. So I think what's going to be very important is the earnings season starting next week. That's going to be of far more importance than any kind of brief inversion in the yield curve, and it's going to keep a close eye on what US corporates can do in terms of growing that top line. I think that's going to be far more important than any yield curve inversion.
And just widening the conversation out a bit, Dennis, everyone has been talking about the Moody's skipping of the downgrade on Friday night. We described it this morning on Power Lunch as like a sword of Damocles over the economy of South Africa. It's a bit dramatic, but what was your take on it?
Yeah, look, a bit of an anticlimax. I mean, obviously people were gearing up to look at either the potential outlook change or maybe a ratings change. And then they just listed a number of countries. I think it was like 6 countries that they said that they were not going to actually release a review. And you know, the next official review is 1 November. So that's quite a big reprieve, but of course they can come back at any time. So it's not that we've been let off the hook totally. But I mean, the Rand seems to have liked it today.
Yeah, I mean, it's incredible. I mean, it's trading strongly this morning. I mean,
yeah. And I mean, that's very good price for very good news for the oil price, the fuel price. Yeah. I mean, we're going to have a shock on Wednesday, but if the Rand stays at these sort of levels, we'll have a pullback, a strong pullback.
Sure.
Which should help us in May or in June, the June actual number.
So, Nadir, your colleagues in the markets, I mean, what was the chat this morning about it?
It's nothing about nothing, you know. I mean, I think there's a lot of noise being made about what are Moody's going to do, and is it going to be the end of the world? I think the bottom line is that there was a lot priced in, you know, prior to the downgrade. I mean, junk was more than priced in. To give you a kind of indication, our CDS spreads, which is the cost of, as your viewers would know, it's the cost of insuring against South Africa defaulting, was at about 290 basis points, and that was about 20 basis points above that of Russia, who's already rated sub-investment grade, and about 25 basis points above Brazil, which is 2 notches below where South Africa currently is. So junk was very much priced in. I think symbolically we would have seen obviously outflows from our bond market in preparation of being kicked out of the World Government Bond Index, but that would have been very short-lived, you know, and that the yield investor would have repelled back into the South African bond market. So I think long-term structurally our issues are not going away. In fact, I just saw a news story released today that we're 15 billion short on what we expected to collect in tax revenue. So this problem ain't going away. You know, tax collections have been revised downwards continuously since 2015. The budget deficit is widening as indicated in the budget, and although you know, the bailouts of the state-owned entities are being done in a budget-neutral way in terms of cutting in other areas, if we don't prop up growth, that budget deficit is just going to go nowhere, and we're going to continuously breach the spending ceiling in terms of, you know, a couple of years ago, a hard cap of 50% to GDP. We're going to exceed that by quite a long distance before debt stabilizes. So the bottom line is that the pressure is still very much on South Africa to get growth going again, and we're going to have to wait and see what impact load shedding and Eskom has in terms of getting that growth going.
Well, that's the case in point there. I was reading this morning, unless growth reaches 2%, or was it debt to GDP is down to 4% or below 4%, then it's inevitable that we're going to be downgraded. But my question always to you economists is, where's that growth going to come from?
Well, it's not looking great at the moment. We've actually just downgraded our forecast. We were at 1.3, which is what the Reserve Bank's moved to now, but we've moved down to 0.9 because of impact of load shedding in the first quarter, and what we think will be a continuing program through the winter period at least. So I mean, I have to agree. I think the structural issues are enormous, and we really are struggling to get that growth rate up. I mean, the magical figure there is that you should actually have real growth rates above real interest rates, the average interest rate that you're paying on your debt. Otherwise, you have to run a primary surplus, which we're nowhere near doing at this point. So it's all about growth. Growth actually determines how much tax revenue you get in. And bear in mind that this shortfall that we were chatting about earlier on is from what they estimated in February. So
it's already downgraded.
So it's already down over like a month and a bit, which is not great news. And with all those forecasts being downgraded, you will actually see lower revenue numbers coming through.
Because that's the point. I mean, you must be seeing your line of work. I mean, the amount of companies who aren't paying tax anymore or less tax. I don't know. I mean, I think this is going to get even bigger, this amount of SARS money that's not being collected.
Yeah, so corporate tax collections was actually down over 3%. You know, so it is, you know, the personal income taxes were down just above 1%. Corporate taxes down about 3%. The bottom line is that companies are not making as much money as what they were. So even if companies are compliant, which is a very big if, they're simply just making less money, therefore they're paying less tax. You know, and we're seeing it in the JSE corporate results that are coming out. You know, retailers are really having a tough time. You know, any kind of company that's faced towards the local economy is guiding for lower profitability, lower revenue growth, margins which are declining. If they're staying stagnant in this environment, that's really a big win for companies facing the domestic economy. So, you know, it is tough going, but I think the reality is that there's no use getting overly bearish about these things. You know, if confidence can come back into the system, that can unlock quite a lot of investment, because corporates are actually in a very healthy state. If you look at the amount of borrowings that corporates have has been coming down drastically, and we see that in the bank's earnings. You know, their loan growth has been very subdued for a number of years now, and corporate balance sheets are in good shape, you know, in excess of 2 trillion rand of cash in their balance sheet. So if we can get some confidence back into this economy, you know, I think that can unlock growth quite quickly, and especially given that we're coming off such a low base, you know, I think things can happen. But the bottom line is that we have to address issues like Eskom, and that's certainly not helping confidence, and we're a long way away from addressing that. So we're going to have to wait and see what happens.
Well, I see, just going back to the tax issue, we're talking, the tax people are saying there's been too many refunds. That's why there's takes time. But I find that very hard to believe. But we're going to go there live later in the show to find out what's the latest with the strike there. But one last thing before we go, we're almost out of time, is Dennis, please give me some hope about how this economy is going to turn around, I think, before we finish this discussion. Yeah,
look, I mean, the headwinds are real. We've got Eskom, we've got the global economy, but I think the key is the domestic policy environment. If we can actually start to roll out the red carpet for fixed investment spending and for job creation, make it a much more business-friendly environment. We've concentrated too much on the demand side of the economy in terms of higher wages and so forth for public service workers. That's not worked. We've now got to actually look at the supply side and make sure that we've got a positive business environment, and then the money will come, because we've got good infrastructure generally. We've got a good sort of justice system and so forth. There's no reason why we shouldn't be growing at 2.5%, 3%. But the policy environment has to be a lot more conducive.
Just one last quick one to you, Nadir. I mean, how confident are you, or otherwise, after the elections, if Ramaphosa gets a strong mandate, that he will lay it out for the red carpet for foreign investors?
It's a difficult one to tell, because it continuously seems like there's an event on the horizon where we say, after this, we're going to have more certainty. After this, we're going to have more certainty. You know, it was the ANC elective conference. It was then, you know, the Zondo Commission, and it just seems to be continuously moving the goalposts. Look, I mean, the bottom line is that without a strong showing in the election for Cyril Ramaphosa, we're probably not going to get that business-friendly environment, and we're going to see the dire consequences of that. So one would hope that you can get a strong mandate, because without a strong mandate, is working with a compromised ANC. We all saw the revelations that came out this weekend about Ace Makashule and the corruption over there. The bottom line is that he's working with one hand tied behind his back. It's a very difficult thing to do when your economy is not growing. So I suppose the best outcome for everybody is getting a strong mandate by winning the election by quite a margin, and then obviously being able to implement policy as he sees best for the country going forward.
The economy. As somebody said, who remained nameless, very cynically on this show this morning, that he believes there's a dusty filing cabinet in the union buildings full of plans on how to fix the economy, and it's just sitting there. I don't know, maybe we shouldn't be cynical at this time of elections. Thank you very much, gentlemen, for your time and for your inputs. That was Nedbank's Chief Economist, Dykes, and Nadir Thokan, Investment Analyst at 274.